Welcome to the deep dive.
Oh.
So our mission today, it's pretty laser focused. We are unpacking the timeless investment philosophy of Philip Fisher.
The man famous for finding those really high-quality growth stocks.
Exactly. And we're extracting the essential roadmap for achieving what he called uncommon profits in common stocks.
Yeah, this dive, it's really all about the durable principles,
Yeah.
Not fleeting tips. We're going straight to the core wisdom, the nuggets from decades of, incredibly successful investing.
Right.
We want to separate out the fundamental framework, his famous 15 points, and that rigorous Scuttlebutt methodology from all the noise you hear, day to day in the market.
Makes sense.
The goal isn't just what leads to success, but really understanding why these enduring principles drive superior long-term performance.
And right away, the source material gives us this really powerful hook, I think, for you, the listener. Fisher's son actually admitted that when he first read his father's big book.
Yeah.
He was 8 years old, and he said it made darn little sense. He basically felt like it was just a bunch of big words ruining his summer vacation.
That's the perfect context, isn't it? Because he later revealed that the true learning process, actually getting it, took him something like 15 years to really master.
15 years.
Yeah, he tried applying the 15 points right out of college, playing, I think he called it wannabe kid sleuth, and apparently failed miserably.
Why?
Because he hadn't yet learned how to ask the meaningful questions, or how to truly evaluate management.
Mm-hmm.
It just tells us this wisdom isn't something you pick up instantly. It's a craft.
Mastered only through practice and, experience.
Exactly.
That 15-year learning curve is, it's really fascinating. It shows this isn't just passive knowledge you absorb. So, okay, if we connect that struggle to the overall philosophy, where did Fisher fundamentally break from the investment norms of his day? Back then, wasn't it all about cycle betting?
Pretty much. The traditional way to make big money was buying low in economic busts and, selling high during the booms.
Right.
Fisher completely shifted that focus. And instead of trying to time the whole business cycle, he zeroed in on finding companies with management that could grow sales and profits way, way beyond the industry average, year after year.
So consistency over cyclicality.
That's it. He proved the biggest investment rewards go to those who find that, that occasional company that can deliver spectacular growth over many, many years.
Okay, so when you talk about the 15 points, which is like the core diagnostic tool here, what exactly are we talking about? Does this only apply to, say, young, high-flying tech companies?
Oh, not at all. That's a common misconception. The 15 points are really a comprehensive prescription, a checklist almost.
Okay.
They help you find firms with huge product and market potential, and crucially, management that's determined to exploit that potential way beyond just the current product line.
So looking ahead.
Always looking ahead.
Yeah.
And importantly, the points cover everything from R&D intensity, operational efficiency, management determination, personnel relations, and maybe most critically, integrity. It's holistic.
And the ideal company doesn't necessarily have to be small or new, right? What really counts is that management has this determination for further important growth and, of course, the ability to actually execute.
Precisely. And a huge part of this, especially when Fisher was developing his ideas, was the rise of corporate research. Back in the late 1920s, very few industrial companies had significant research departments. Fisher saw that R&D was becoming the real engine of modern corporate growth.
I wonder if that adoption of R&D was, slow at first, or did it just explode once people caught on?
Oh, it exploded.
Right.
There's data showing private corporate R&D spending went from about, $3.7 billion in 1953 to a massive $7.3 billion by 1957.
Wow, in just 4 years.
Yeah, nearly 100% growth. That ability to harness science and tech and then combine it with effective commercial execution, that's what the 15 points are designed to sniff out.
And what's really valuable, I think, for you listening is the flexibility here. Fisher, the father, he was definitely a growth stock fanatic. But his son found these same 15 points worked just as well when he was looking for undervalued companies, high-quality firms that were just temporarily cheap.
That's a key insight. They are universally desirable attributes for a business.
So the principles of quality, management integrity, they apply no matter your specific investment style, whether it's growth or value.
Exactly. That's a really key distinction.
Okay, let's talk about the main mechanism for actually verifying these 15 points. This scuttlebutt idea, it sounds like it requires some serious investigative work, like real shoe leather.
Oh, it absolutely does. Scuttlebutt isn't just casual gossip. It's a highly sophisticated form of Intelligence gathering, really.
How so?
It means finding out if a company is genuinely strong from real Main Street sources. You're talking to sales reps of competitors.
They're rivals.
Yes, and research people to competitors, plus customers, suppliers. The evidence suggests that if the competitors who have every reason to be biased against the company actually respect it, maybe even fear it,
then you know you're onto something good.
you can pretty much count on that strength, yeah.
So the key isn't just knowing the 15 points on paper. It's being willing to, make the 100 cold calls needed to actually verify them. That sounds like the repetitive craft of investing, just grinding out the data gathering.
It is the craft part. But Fisher makes this really crucial distinction between the craft and the art.
Okay, craft versus art. Explain that.
Well, the craft is learning the process by repetition, like practicing scales on a piano. You do it over and over. The art, though, is the creative, investigative skill that's like composing the music itself.
Ah, I see.
So rigidly running down a standard checklist of questions, that's craft. The art is asking the right follow-up questions, the ones that flow naturally from the answers you're getting, not sticking to a script.
That distinction really changes everything, doesn't it? It means the real skill is in the follow-up, the improvisation based on what you hear.
Exactly.
And the source material shares this fantastic anecdote about the greatest scuttlebutt question Fisher ever learned. It came from James Walker Michaels, the legendary Forbes editor.
That's the one. It's a real nugget of scuttlebutt wisdom.
Yeah.
The question is simply, what are you doing that your competitors aren't doing yet?
Wow. Okay, so that question basically forces management to confront whether they're true innovators or maybe just fast followers.
Spot on. And the emphasis is on the word doing. It's about action, not just talk. Apparently, most companies, when asked this, aren't actually doing one darn thing of any great significance that competitors aren't already chasing. The truly great companies, the ones Fisher sought, they consistently ask themselves that question. And crucially, they act on the answer. They innovate.
Okay, let's pivot back to the 15 points themselves, maybe look more at the qualitative stuff, things like management, discipline, integrity. Thinking about the son's initial failure you mentioned, was that partly because he lacked the scuttlebutt skills to verify these less financial points?
Almost certainly. I mean, you have to look really closely at the things that don't just jump off a balance sheet. Take point 7, outstanding labor and personnel relations. Fisher observed that the difference in long-term profitability between a company with genuinely excellent employee relations and one with just mediocre relations is far, far grayer than just the direct cost of, say, the occasional strike.
Right, it's deeper than that. So how does an investor doing their scuttlebutt actually spot that quality? What are the signs?
You look for measurable indicators, things like low labor turnover rates, maybe long waiting lists of people wanting to work there.
Interesting.
And companies that manage to pay above average wages but still achieve above average profits. We see examples like Motorola and Texas Instruments back in the day maintaining successful non-union status even in highly unionized areas.
How'd they manage that?
Well, the only explanation is personnel policies that genuinely made employees feel valued and, as a result, highly productive.
Then there's point 12, the long-range outlook. This is where management has to be willing to sacrifice some short-term gain for long-term benefit.
Exactly. Management must be willing to, say, curtail maximum immediate profits if it helps build permanent customer loyalty, or invest heavily today for growth that's years away.
So no chasing quarterly results at all costs.
If management only pays lip service to that discipline, if they're totally fixated on the next quarter's numbers above everything else, Fisher argued the investment just won't thrive long term.
And you mentioned integrity earlier. Point 15, unquestionable integrity. You said it's the single most essential point and that Scuttlebutt offers the most protection here. Why is that?
Because it's absolutely non-negotiable, and it's hard to see from the outside. Insiders, well, they have an almost infinite number of ways to benefit themselves at the expense of ordinary stockholders.
Like what?
Oh, excessive salaries for relatives, maybe buying or selling corporate property at advantageous rates, abusing stock option grants. The list goes on. Management must have a highly developed sense of trusteeship, of moral responsibility.
And only Scuttlebutt can really uncover that.
Pretty much. Talking to those former employees, suppliers, competitors, that's how you get a sense of whether that integrity is truly present or if it's just talk.
What's fascinating is how Texas Instruments, you mentioned them before, actually tried to quantify this soft skill. The source mentioned something called the People Effectiveness Index.
Yes, the People Effectiveness Index. It was defined, I believe, as net sales divided by total payroll. Now think about their main business back then, Semiconductors.
Right. Prices always falling.
Consistently declining unit prices.
Yeah.
And at the same time, wages were generally rising.
Yeah.
So logically, that index, sales divided by payroll, it should have fallen over time, right?
Yeah, you'd think so. If wages are going up and prices are going down, wait, how could that ratio possibly go up? What does that index rising actually tell us?
It tells us that through outstanding personnel programs, through really maximizing their human capital, their actual output per dollar of payroll was increasing dramatically, despite those headwinds.
Incredible.
The index actually rose from about 2.25 in 1969 to 2.5 by 1973. That's measurable profit derived directly from human efficiency, showing the enormous power of getting 0.7 right.
Okay, let's shift gears a bit. We've talked about what to buy, using the 15 points in Scuttlebutt. What about when to buy? Or maybe, as Fisher might say, when not to sell. He observed the market has this inherently deceptive nature, often driven by fear.
That's absolutely right. And that's where things like the efficient market hypothesis often fall short, because human psychology can be, well, spectacularly wrong sometimes.
How so?
Doing what everyone else is doing, following the herd, which, you feel this almost irresistible urge to do sometimes.
Yeah.
That's typically the wrong move in investing, according to Fisher.
Can you give us a classic example of this mass psychology just being completely off base?
Sure. Look at the periods from 1946 to 1949. Corporate earnings were actually pretty pleasing. Things looked okay on the surface, yet stocks were selling at the lowest valuation multiples in years.
Low PE ratios, you mean, price divided by earnings. So the price was low compared to the profit the company was making.
Exactly. Dirt cheap, relatively speaking.
But why? If earnings looked okay, why were investors so pessimistic they wouldn't pay up for stocks? Was it just like historical PTSD from the Depression and the war?
It really was. The whole investment community seemed mesmerized by this belief that, just like after the Civil War and World War I, a horrendous post-war depression must follow World War II. It was seen as inevitable.
So they were convinced American business was, worth more dead than alive, as the saying goes.
That was the sentiment. And this created a massive opportunity when that overwhelming fear proved completely false.
And we see a similar, though maybe contrary, irrational psychology during war scares too, right?
We do. Fisher observed this really interesting contrary historical trend. Stocks almost always plunge sharply on the fear or the actual arrival of a major war.
Makes sense, uncertainty spikes.
But they almost invariably end up vastly higher by the time the fighting concludes.
Wait, vastly higher?
Right.
Why? So are we saying the stocks aren't actually getting fundamentally better? It's just that the dollars used to buy them are worth less.
That's precisely it. Modern war inevitably causes massive government deficits. That drastically increases the money supply, which causes inflation. So the reason to potentially buy stocks during war scares isn't because conflict is good for business.
Right.
It's because stock prices are ultimately expressed in a currency that's constantly being devalued. Holding cash in that scenario is often the worst choice.
Okay, so if trying to perfectly time the market based on cycles or news is generally a fool's errand, when is the ideal time to actually execute a purchase of one of these high-quality firms you've identified?
Well, according to Fisher, the best time to buy is often when a fundamentally good company, one that passes the 15 points test, is experiencing temporary troubles.
Temporary troubles? Like what?
Something that causes a significant but likely short-lived drop in the stock price. Maybe a technical failure during a new plant startup, a short labor dispute that gets resolved, maybe a single product line that flops but doesn't damage the core business.
Ah, okay.
The key is that the investor, having done their scuttlebutt, is confident the problems are genuinely temporary and will likely be solved in months, maybe a year or two, not fundamental long-term issues.
So you buy on the temporary dip, assuming the long-term quality is intact. And the ultimate lesson then, after all this intense investigative work, finding the company, verifying the points, maybe waiting for that temporary trouble, it's really the power of simple patience, isn't it?
Absolutely. The sheer magnitude of gains possible with patience, once you've done the homework correctly, is incredible. Look at that Texas Instruments example again.
The 3,500% gain.
Yeah, $10,000 invested in 1953 would have become worth over $350,000 just 6 years later. Over 3,500% return. The lesson is clear.
Yeah.
The really big profits come not from constantly trading in and out, but from finding the right companies and holding them for a long, long time, letting that growth compound.
So as we wrap up this deep dive, what we've really explored, I think, is the immense value of cultivating an investigative mindset doing the scuttlebutt, and also recognizing the powerful, often misleading psychology that can blind most investors. And maybe the son's ultimate realization is the most valuable nugget for all of us. The ideas that spring up in your mind inspired by reading classic wisdom like Fisher's are often even more valuable than the text itself.
That's a great point, and it brings us right back to market psychology today, doesn't it? We're reminded constantly that stock values are frequently held back by exaggerated external fears. The source material kind of poses this question: will the core problems that worry investors today, things like high energy costs, geopolitical dangers, maybe credit overextension, will they eventually be viewed in hindsight like those post-WWII depression fears were, as overblown?
That's a really important question for you, the listener, to ponder. Are the current worries holding back stock prices right now, here in the mid-2020s, potentially as exaggerated as they turned out to be back in 1949?
And could that psychology, that fear, actually be setting the stage for a period of really rewarding opportunities in the next decade or so? Something to think about.
Definitely food for thought. And in the meantime, maybe take that stunningly cunning question we uncovered from James Michaels and apply it beyond just investing. Ask yourself, what are you doing in your own career, or maybe your own business, that your competitors aren't doing yet?
Great call to action.
We'll leave you with that. Thanks for joining us, and we'll see you next time for the next Deep Dive.